Hey guys, for more like this, don't forget to hit the subscribe, the like button, and the notification bell. Okay guys, it's Kevin Wadsworth, Patrick Karim at NorthStarBadCharts.com, and we've got the great honor of having Brent Johnson from Santiago Capital joining us today. Hi Brent, how you doing?
I'm good. Thanks for the invite. This is gonna be fun, interesting and fun. It'll be interesting to see where we agree and where we disagree.
Well, yeah, I mean, myself and Pat are technical chart analysts, of course, and we sit all day staring at charts and analyzing the evidence that comes out of the technical charts. But obviously, there's a lot of fundamentals as well to be considered, and that's what you're here to tell us about, really. Or I think you're most well known, most sort of famous, I suppose, for the US dollar milkshake theory, and I think probably a lot of people listening to this podcast will have heard of the US dollar milkshake theory. I've seen the video and the podcast on it on your Twitter feed. So anybody that hasn't, go to Brent's Twitter feed, and you can see the really good video there done by I remember who did that. Was it Real Vision or
Real Vision did it for us. Yep.
Yeah, that was it. But yeah, I mean, if you can just explain sort of in brief what it is and how it works, that'd be great.
Sure. Sure. So the dollar milkshake theory, I think some people think it's just a trade, and some people think that it's just the dollar going higher. And while those are kind of two parts of it, what it really is, it's kind of a fundamental framework for how I see a sovereign debt and currency crisis playing out. This is the milkshake is what I think will play out if and when we get into a sovereign debt crisis. Now, I'm the first to admit and hold up my hand that I thought that we would have a currency crisis or a debt crisis before now, and we haven't. And in our business, when you get the timing wrong, you're wrong. So if anybody wants me to say I was wrong, I'm happy to put up my hand and say I was wrong. But we won't really know whether the theory is wrong or not until and if we ever get into a sovereign debt crisis. If we get into a sovereign debt crisis and it plays out completely different than the framework I've played out or laid out, then again, I would have to raise my hand and say, this was just fundamentally wrong. But until then, we just really don't know. I think it has really helped me navigate the markets for the last 4 or 5 years. It's given me a framework via which to understand everything that has gone on. And essentially what I have said will happen is that as we get into a sovereign debt crisis, all the central banks of the world, all the countries of the world, not just the US, will have to resort to extraordinary measures, whether it's QE, whether it's stimulus, whether it's bailouts. They have had to do this since the global financial crisis, and I think they will have to do it even more so as we move forward. And any of this new money or liquidity, however you want to define these extraordinary measures, as this liquidity gets puts into the market, I think on a relative basis, the US will look like the safest port in a storm or the cleanest dirty shirt. However, whatever relative analogy you want to use, I think the dollar, some of the reasons perhaps we deserve and some of them are undeserved, but for a number of reasons, the US has a number of advantages and the US dollar has a number of advantages that the other currencies just don't have. And as a result, I think that capital will flow into the US dollar. I think while when I originally kind of started talking about this in 2018, I said that we would ultimately get into a scenario, or in the years ahead, and ultimately get into a scenario where the Dow would rise, the dollar would rise, and gold would all rise together versus everything else. And if you look back to the summer of 2018, when I first started talking about this, the dollar's up versus all the other currencies. Gold is up versus all currencies, and the Dow is up versus all other equity indices and up versus the dollar. So to a sense, it's played out in that same time period. I said, or in that same initial interview that I gave about it, I said, even though these would all trend up over time, it would be characterized by terrifying drawdowns along the way. And I think it's fair to say we've had some terrifying drawdowns along the way as well. And so that's why I say it's really kind of helped me navigate the markets over the last 4 years. Whether it helps me going forward or not, that's still yet to be determined. The name came from a movie called There Will Be Blood. Daniel Day-Lewis played the lead actor. He won the Best Actor Oscar for this role, where he was this ruthless oil baron, is about the best way I can say it. And there was a scene at the end of the movie where one of his competitors was trying to convince Daniel Day-Lewis to buy his land. And he said something to the effect that if you buy my land, you can have all the oil that's underneath it. And, your land is right next to my land. You might as well buy it. You can have all the oil underneath my land. And Daniel Day-Lewis says, I don't need to buy your land, because all I have to do is stick a straw down in on my side of the fence and I can drink your oil. Or he said, I'll drink your milkshake. That was the big line from the movies. I drink your milkshake. And to me, that kind of explains what's happened over the last, few years, and what I think will happen in the years ahead. Is, to me, it doesn't really matter who injects the liquidity. What's more important who captures it, who drinks it. And I think for a number of reasons, the US and the US dollar have the straw, while the rest of the world doesn't. So I think that's where I've said, the US will drink the milkshake that the rest of the world mixes. Now, again, whether that plays out or not, we'll have to wait and see. But so far, it's worked out fairly well for me. And anyway, that's what it is, and that's where we're at now. We've had a big run up. We had a big run up from 2018 to 2020. We had a big pullback. We had another big run up, and now we've had another big pullback. So it'll be fun to look at your charts and kind of see what you guys see on a technical basis and from a timing perspective.
Yeah, well, I can show the chart that that I sort of put together that sort of initiated this conversation. Interesting, you should say though that the US dollar index going up and gold going up, because a lot of people listening to this will kind of think that sounds somehow wrong, and I've been banging on about this for a long time, because on the short time frames, of course, a rising US dollar index can put pressure on the precious metals. But when you zoom out and you look at it over a period of years, you'll notice that in the time period since the US dollar index was around about 70 and it moved up to well over 100, gold has moved up by several $100s. So zooming out a little bit, what you notice is that each time the US dollar index goes up, gold pulls back a little bit, but then when the US dollar index falls, gold rises a lot. So it's kind of out of proportion. The moves that take place in the US dollar between the US dollar index and gold, it's not somewhat out of proportion, so that over a period of time, gold actually isn't just reacting to the US dollar index, it's more specifically, in fact, reacting to destruction of purchasing power. And it's that loss of purchasing power that is what gold is measuring. It's sitting there as a barometer, it's not really doing anything, it's just measuring your continual loss of purchasing power as a result of inflation, of course. I'll show the chart. Since you mentioned it, I'll put the chart on the screen. I'll share my computer screen. If you just bear with me a moment, I'll do that.
Brent, while Kevin's setting that up, I'm curious to what. So let's say gold and DXY are going up together. How do you see inflation during that period? Low, moderate, or high, or are you part of the hyperinflation camp where?
Well, so this is where it gets really interesting, and it kind of depends on who you are and where you're located and what your home currency is. And why that is so important is it kind of goes back to what Kevin was just talking about, is that I think one of the main reasons that some people have resisted this idea was when I said gold and dollar will rise together. And I think many people understand that can't possibly happen because they're opposites. And it's true, if you just want to look at the purchasing power versus the dollar versus the purchasing power of gold, they can't probably both go up together. Well, they could theoretically go up against each other, or with each other or against each other. But what I'm really saying is that while all purchasing power may fall in all fiat currencies, because fiat currencies lose value over time, right? But if the dollar is losing less purchasing power than the euro, the yen, the real, et cetera, then the dollar is rising versus all of those currencies, and gold is rising versus all of those currencies. So coming back to your question versus purchasing power or inflation, I feel like we're going to get into a scenario where in the US, you could have high levels of inflation even though the dollar is rising. We saw that last year. We had, inflation at a 30-year high, and the dollar was at a 30-year high versus all of its peers. So the idea that you can't have inflation with the DXY rising is incorrect. You could also have a situation overseas where if the dollar is not your home currency, you could be getting both deflation and inflationary pressures at the same time. And the reason is because much of the world trades in dollars and has borrowed in US dollars or finances their operations in US dollars. So if you get into a situation very much like last year, where the US dollar is rising in value, but goods and services are rising in price versus the dollar, but a foreign currency is falling versus the dollar, then their prices are going up even more, right? And so then they have very high levels of inflation for needed goods and inputs, but they're also getting squeezed from deflationary pressure from their funding currency going up in price. And so that's very stagflationary. So if you've borrowed in dollars, if you live in Europe and you've borrowed in dollars, last year you got put in a really tough spot because your financing costs are going up, because not only are the interest rates rising in the US, but the price of the dollar is rising in the US. So that cost of funding is going up. But at the same time, goods and services are rising in price in US dollars, and they're rising even more in euros. So, they're getting, and as a result, their business is slowing. And so it's kind of a double whammy. And so that's ultimately how I think the whole milkshake theory plays out, is I think, we will get into a period where we will kind of have this global hyper stagflation. Some people will be experiencing great deflationary pressures. Some will be experiencing great inflationary pressures. Some will be experiencing both at the same time. And the US may even be feeling them at the same time, but I think they will be able to handle them better than the rest of the world. I do not think the US dollar is going to go into hyperinflation. It is possible, but in my opinion, only after every other currency has gone through hyperinflation.
Okay, well, let's take a look at. Sorry, Pat, you can say.
I just said, yeah, it's going to be the last man standing, because the way I see it, gold's at the top of the pyramid, but like my father's Lebanese. I went last time I went to Lebanon. The next best thing is the US dollar. So
yeah,
so it's gold. Yes, they hold the jewelry, but nobody transacts in gold until something's on the blockchain.
I have a Lebanese client. I just saw him in Switzerland a couple of weeks ago, and that's exactly what he was saying too. He says, yeah, everybody has gold, but everybody holds dollars as well. It's the first thing we go by, because the Lebanese currency is so.
Yes, that was in 2017 when I went there. But before that, I didn't understand what reserve currency meant until I went there, and people were dealing with US dollars. Like one US dollar was 1,500 Lebanese pounds back in 2017. Now it's over 100,000 Lebanese pounds.
Right.
So the US dollar is creating deflation there. So if you're if you go there for US dollar, you're king now, because everything's super cheap for you, right?
Right. And then let me just say this in case I forget to say it later, that there's a lot of people who have said to me, yes, the dollar index may be rising, and maybe the dollar is falling faster than all the other fiat, but it's still falling in purchasing power. Therefore, it doesn't matter. I think anybody who says that probably lives in the US or Switzerland, and their currency has remained very strong for the last couple of years. Go around the world, even just 6 months ago or 12 months ago, or even this year, and ask them, if relative currency matters, relative currency levels matter. And they will all tell you that it does, because they all in some form or another need dollars to operate. So I often think it's a bunch of local Americans who have never traveled who say that relative currency levels don't matter.
You're describing your Twitter followers.
Yeah, well, maybe so.
I'm kidding. I don't know. All right, sorry, Kev. Let's go to the charts and disprove everything that Brent said.
or not, or not, as the case may be, because you can see a big red arrow on the chart here that it says milkshake scenario. Really, the US dollar index, to my mind, there's two ways of looking at it. Since the 1970s, when the US came off the gold standard, that period leading up to this huge rise here, you saw the US dollar index dropping during the early to mid 1970s, and it suddenly accelerated very, very rapidly to the upside, starting around about 1978, and catapulted up to over 160, 165. And there's a huge amount of, from a scientific point of view, there's a huge amount of momentum and energy in this very, very rapid rise. And just keep that in mind for a moment, that when you get an incredibly almost vertical launch like that, there's a lot of energy that gets carried through to a point. You can imagine if you're throwing something vertically and you throw it with a huge amount of energy, it's going to go further than perhaps you might expect if it just went up with a kind of an inverted commas normal sort of launch. Now, once the US dollar index sort of settled into a rhythm, if you like, and the effects of the being taken off the gold standard kind of subsided, we developed a very clear sort of roughly 15-year cycle so far in the US dollar index. Now, it's hard to say for certain that cycle is particularly valid because we've only had 2 complete cycles, and the third cycle here is somewhat different in nature. But the main thing I want to mention here is that from a technical chart point of view, there's 2 ways of analyzing this. You can view that top there as a blow-off top, and if you do, and you join the start of the US dollar index in 1969, the peak, to the peak of the cycle in 2001 there, to the peak of the cycle in 2022, or the recent peak, then you have a very clear major resistance line, and at the bottom you've got a very clear major support line, and those lines offer clear support and resistance. So that's one way of analyzing the big picture in the chart. The other way of analyzing it is to accept this 165 peak as being very valid, and then join that to the peak in the second cycle, and then continue it down where there has been a reaction on that milkshake line. We broke through it, and then the chart came back and back tested it on multiple occasions. So it gave validity to this red line here, the milkshake line. The reason I called it the milkshake line, Brent, is because from a technical analysis point of view, when you get a breakout from a descending wedge pattern, which is what that would be, the red line on the top and the black line on the bottom, that's a descending wedge. They're very bullish from a technical chart perspective. And when they break out, they lead into a bull market. So if that's the case, then what I would expect is for the current US dollar index pullback to probably finish its pullback at around about point A, where you've got multiple support. You've got support from this little black line here that you can see has been relevant in the past during the previous breakouts. You've also got support from the edge of this possible arc pattern that I've drawn on here. You've also got support from horizontal support lines as well. So this point at 95, I think, is where we're going to find out from a technical chart perspective whether we progress all the way back down to point B, and point B is the final, in my view, the final opportunity for the milkshake theory to come to life. Because when we hit point B, that will be a full retrace all the way back down to the support line. And from a technical chart point of view, if we don't bounce there and go to a massive bull market, then it's probably not going to happen. I won't say it's definitely not going to happen, but it's probably not going to happen. Or if it does, it's going to be at some point, probably after I'm dead. But a reversal either at point A or at point B, so at 95 or roughly 76, a rapid reversal from either of those levels, and the theory could very well play out. A breakdown at point B means that the bullish descending wedge isn't valid either, and we're back all the way down to point C, somewhere down in the 60s for the US dollar index.
Oh my goodness. Kevin, before Brent comments on that, are you telling me technical analysis, it's a coin flip? What's the use, Kevin? It could go up, could go down. What are you doing to us? It's like,
it could go up, it could go down, it could go sideways, but the points at A, B, and C are the information points. They're the points on the map, on the road map, where there's a fork in the road, and a technical analyst will very quickly recognize where the next path is going to be. The current path takes us to point A, and then the next path will either be that rise or that drop. And then when we get to point B, then you have another choice to make. So these points A, B, and C, they're decision points. Also, just one thing I wanted to mention as well, I noticed when I was listening to the podcast about the milkshake theory, is that the rate of change of the US dollar index can be very important in terms of the milkshake theory. So we've got the rate of change indicator on the bottom of the chart here. So the rate of change is clearly quite cyclical. Up, down, up, down, up, down. The black line is the rate of change for a 7-year time period. It's a 7-year rate of change with a 3-year moving average. That's the green line, the 3-year moving average.
Is that the 7-year, Kevin, or it's 7 periods? It's or it's because you're on the 3 months. So, okay, it is a 7 year.
The 28 period, 7 year, so 28 lots of 3 months is 7 years, and 12 lots of 3 months is 3 years. So you've got the 7-year rate of change and the 3-year moving average. And you'll notice that when you get the crossover of the moving average crossing below that green line after a cyclical peak, it's a good indicator that we're in a long trending sort of downtrend. This whole period here has been somewhat different to the previous 2 peaks. A little bit like zone 1 was very steep, zone 2 was less steep, and then zone 3, this large zone between the resistance line and the red support line, is less steep again. So with each cycle, it sort of feels like we're losing some momentum. The topping pattern is at a lower point each time, so it sort of feels like a decaying type of situation from the point of view of the rate of change. But you know, for the milkshake theory to really take hold, this rate of change needs to rapidly start to move to the upside. So again, from a technical chart analysis point of view, you can draw a very clear line in the sand right there. And when the rate of change, if and when the rate of change crosses that line, that's when the milkshake theory might start to really, you know, come to life. You got comments on that, Brent? What do you think?
Yeah, so I think the first thing I would say is I really like this chart, and from a timing perspective, I really don't have a problem. People may be surprised to hear me say this. I really don't have a problem with the potential timing that you've laid out either. A couple observations, and this is where I'm overlaying my fundamental analysis on a technical chart, right? Again, the whole milkshake theory is not based on technicals. It's based on fundamentals.
Yeah.
But if we go back to, you know, the big move up in the early 80s, right? That was the main reason was this was a result of the Volcker's policy of raising interest rates, trying to crush inflation, right?
Yeah.
So we raised interest rates, raised interest rates. That pulled capital into the dollar. It made the dollar rise versus foreign currencies. And it, you know, to your point, the faster it goes up, then the faster it's probably going to come down as well.
Yeah.
But when we got to that peak, the peak is when we had the Plaza Accord. Okay. So the Plaza Accords is when the Fed went to all the other central banks and said, okay, the dollar's very strong now. We want it to weaker, and you are going to help us get it weaker. Now, the Japanese economy was an export economy, and the European economy was an export economy, and they didn't really necessarily want to strengthen their currency massively against the US dollar. But that was the program that the Fed laid out, and they all bought into it. And so over the next several years, you know, they worked together to get the dollar lower, and they did, right? So, and then can you pull it back up? I just lost the chart. Can you pull
sure.
it back up?
I stopped sharing the screen there so we could
Sorry.
talking. But,
I didn't understand why you took it away there. It's like a rug pull. Because we know that chart by heart. But Brent, he probably not as he probably didn't see that chart as often.
Yeah, so you know, then we had the big pullback, and then after the Plaza Accord was over, I mean, they did that for a couple of years, right? From 85 to like 87, and then once it was down, then they just, you know, it kind of went sideways to down for the next, call it 4 or 5 years, right? And then it had another run up, and then part of the reason, I should probably say this, part of the reason is you never have really, really long multi-year bull markets in the dollar. And when I say multi-year, you can have a multi-year bull market in the dollar if it's rising slowly. You cannot have a multi-year bull market in the dollar where it's rising rapidly, because it will literally break the entire monetary system, because it's the collateral off of which the whole world is levered. So, you know, when we had the run up into 2000 and 2001, well, then that's when they had the Greenspan started cutting rates again to combat the dot-com bust and, you know, the 9/11, right? And so then they had 3 or 4 years where they cut rates, and they didn't do QE, but they cut rates and cut, you know, did stimulus. And, you know, I remember at one point, I think it was 2001 or 2002, there was even a little form of helicopter money where George Bush was president, and he sent out checks to all U.S. citizens. I remember getting a check. I think it was 2002, and it wasn't that much. Maybe it was $500 or $1,000 or something. But again, it was stimulus efforts to kind of combat the rising dollar and the deflationary pressures of the dot-com bust. So again, and then we get into 2008 where the dollar made a low, but then now we've got the global financial crisis, right? Again, every time the global economy slows, every time there's either a slowing global economy or there's a crisis, the dollar rises. And it makes sense. You can't really have a credit contraction and also have an excess supply of dollars. You know, by definition, a credit contraction is a lack of dollars. And so it makes sense when the supply of dollars starts to dry up, then you will start to get a rise in the underlying currency. And so from 2008 until 2018, from 2008 to 2014, it kind of went sideways. And then at the end of 2014, middle of 2014, that's when the Fed kind of started talking about hinting they were going to raise rates again. At the same time that all the other current countries were still providing stimulus or keeping easy monetary policies. So you saw a big move in the dollar in the second half of 2014, and then it went sideways for 3 or 4 years. And then we got into COVID, where we didn't just have a little bit of a global slowdown, we had a massive global slowdown. They literally shut the whole thing down, right? And so what's interesting is in February of 2020, late February, the Fed cut rates, they did 2 cuts. One of them was an emergency cut on the weekend. And the dollar went from 98 to 94 in about 10 days. And then 10 days later, the dollar was at 102 and the whole world was about ready to crash. Now, subsequently to that, they came out and they did massive QE. And they did helicopter money, they did stimulus, and they got the dollar back down to 90. And then when they started raising rates again, it did just the vertical move up to 2015. So the reason I'm saying this is, left to its own devices, and if we were just in a market where the governments did not interfere, the dollar would be much higher than it is today. The dollar versus its foreign currencies would be much higher than it is today. The DXY index would be much higher. All of the programs that the Fed has done over the last 20 years have been to weaken the dollar as opposed to strengthen it, with the exception of the last year where they raised rates. As they were raising rates, I think they wanted the dollar higher, and they got it higher. The other thing I would say is, the reason I don't have a problem with your timing is if I was just doing this from a technical perspective, back in 2020, when the dollar pulled back to the 95 level, that would have been my line in the sand from a short-term trading perspective. The 95 level in 2020 would have been where I wanted to get out. And then we ultimately went to, I think, 89 or 90. This last year, I would have wanted to be out if I was just doing a short-term trade. And I even actually sent a tweet out the morning of the high, I think it was September 28th, saying this was the point where the dollar was going to pull back. And this is important for me to explain the whole difference between a fundamental trade and a short-term technical trade. The reason I sent that tweet out was this was the point where if the central banks did not get involved and didn't turn it around, it was going to break through that line, the major resistance line, and all hell was going to break loose. Because if it gets through that line, it doesn't stop at 115 or 117. It probably goes to 130 or 150. So that was the last week of September. In the last week of September, the Bank of Japan, the Bank of England, ECB, everybody was intervening in their markets in one form or another to shore up their currencies and their sovereign debt markets. And the US dollar was at its 30-year high versus foreign currencies. The VIX was at a 4-year high or 3-year high. Equities were at a 2-year low. So that was the point where all hell was going to break loose if they didn't turn it around. But they did. All the central banks came out. They started buying their own, or they started supporting their own currencies and sovereign bonds. And we were at this major resistance line that you're talking about. And at the same time, the Fed started talking about no longer raising rates, or at least slowing the pace of raising rates. And at that level, we had gone up and touched the 115 line. from a technical perspective, I think support was around 109, 110 level or something like that. And so from just a technical perspective, that's where I would have been out from just purely trading. And I think at the time I said I thought it would pull back to the 104, 105 level. Now it's actually pulled back to the 101 level. So it's pulled back a little bit more than I thought. But to your point, could it go lower? Could it go to 94, 95? It absolutely could go lower to 94, 95.
Quite a strong support at 101.5, isn't there? So it could.
Yeah, so that's what I'm saying. It's stayed, and this is it's stayed here for a very. I kind of feel like we're at a very important level right now. Like if it doesn't hold here, it's probably going to go to the 95, 96 range. I think there's a little bit of support around 98, and then if it doesn't hold at 98, I think 95 level. Let's call it. So this is why I don't really have a problem with any of your charts here. If we were to go to the B level instead of the A to the B, the funny thing is we could actually go to A by July 1st, we could be at A. That wouldn't take a whole lot, right? If the 100 level breaks, we could go to A pretty quickly.
Yes,
I think to go to B, and even that, I won't say that's impossible. I don't think that will happen, but I can't rule it out. For us to go to B, or for us to kind of trade around the A level for more than a couple months, and let's say it's a year or so, I think we would have to have another round of QE, some kind of a global coordinated QE stimulus where all the central banks kind of work together. I think it's harder to do that in today's. Part of the reason I'm not in favor of it going to B is I think it's harder to do a global coordinated liquidity, program in today's environment versus back in 2020. We have a lot higher inflation today than we did in 2020. The world is not cooperating to the same extent it was in 2020. We're moving towards deglobalization and two supply chains rather than globalization in one supply chain that we had in 2020. And we've got a number of geopolitical factors that I think have to be factored in to see whether we could get globally coordinated, action on this.
Do you think a big banking crisis might do that? Because I'm aware that quite a lot of the banking sector charts, even some of the sort of JP Morgan Chase, who have been in the news for their charts long term.
I think that so here's the point I want to make with QE and how the dollar could go lower. I guess I kind of feel like if you think QE is coming back and they're going to have to do some kind of a major liquidity response, then in the extremely short term, you're probably dollar bullish. Because if the dollar continues to fall, they don't need to do QE. There's plenty of dollars out there. There's no supply constraint. But if we were to get into a banking crisis or a bank run where all of a sudden dollars are disappearing and liquidity is drying up and people cannot get funding, and the dollar goes from 101 to 106 really quickly, or 108, or squeezes back to 106 to 108 level, kind of goes back to that 109 down trend, or that line that I was talking about, the 10. If it squeezes back to there in some kind of a crazy risk off scenario, then it wouldn't surprise me at all to see the Fed come back in, pivot, do QE, maybe everybody does QE, and then maybe we kick the can down the road for another year or two, and we kind of have a repeat of 2020 to 2022. But to me, that doesn't end the game. This, in my opinion, this game is not going to end with the dollar dropping dramatically. It's going to end with the dollar rising dramatically. So I don't think we're going to be, but I can't rule it out. I think A is very possible. But before this is all said and done, I think the dollar goes much, much higher, because not everybody. I think it's a relatively known kind of idea about this grand reset, or this great reset, the fourth turning, the whole new monetary system. The dollar going lower, just in my opinion, it helps the current system to keep going. There's no need to have a big reset if there's plenty of dollars, there's no credit crisis, and there's no debt crisis. It just perpetuates the current system. What breaks the system is your scenario where it gets above that major resistance line and everything starts defaulting, people can't get funding, and it just creates a huge mess. If the dollar goes back to 95 or 90, I mean, that's kind of a Goldilocks scenario for the global economy. It's not too high, it's not too low. So I guess that's kind of my take on the charts. I'd kind of be interested to get your idea on, because you have to remember, if I don't know, have you done a similar analysis on this to the euro or the yen or the other currencies? Because for the dollar to go to the level B, right, that means the euro is back at 130, 140. It means that the yen is back at 90 instead of 130.
Brent, it's the euro. Look, seriously, when people talk the DXY overlay, Kevin, could you overlay the USD euro?
Yeah, it's basically the euro. You're right. It's basically the euro.
Yes. My thoughts was that I want to circle back maybe to the Swiss franc, since we're talking about other currencies.
Sure.
The Swiss franc, in the scenario where gold, US dollar destroys the euro, what are your thoughts on this, the Swiss franc's performance versus the US dollar during the milkshake?
I think the interesting thing is that the Swiss National Bank has been running the milkshake playbook for probably 5 or 6 years.
I don't know what happened with that chart there.
That's a hell of a chart.
Whilst I correct that.
Sorry, Brent.
No, but so for several years, the Swiss National Bank has been keeping rates low. They print francs, they take those francs and they buy dollars, and then they go buy the NASDAQ. So to a certain extent, they're running they're set up to do very well if what I think happens. But I think versus the euro, I would be bullish the Swiss franc versus the euro.
Yes.
Whether the Swiss franc rises versus the dollar or not, I don't think so. But if it does, to me, that's not a big deal. That's not a trade I have on, and I don't feel strongly enough about it to argue really one way or the other. I think probably the most bearish scenario I could come up with is if the yen was rising versus the dollar and the dollar's rising versus all the other currencies. So if the yen and the dollar are rising together versus all the other currencies, to me, that would be massively globally deflationary in dollar terms. It would be massively deflationary in dollar terms, but it probably lead to massive inflation in local currency terms in places like, Turkey or Egypt or Brazil or Argentina, South Africa.
So it's crazy because if you overlay the VIX to the DXY, it goes line in line with what you say. So there's a crisis, US equities, they rupture, the VIX goes bonkers. The DXY for the past 10, 20 years has been tracking the VIX practically, you overlay them, they practice the same chart. So that the milkshake has to happen or will happen during a sovereign bond crisis or debt default.
I believe so. I believe so. I believe so.
And is that when, okay, I don't want to go down the conspiracy of the US losing the reserve status. Does that have anything to do with the reserve currency going somewhere else other than the States, or has nothing to do with that?
I'm kind of open to different scenarios, but my best guess on how this all plays out is that the dollar eventually breaks that major resistance line. It goes really high, whether that's 130, 140, 150, 160, in some kind of a super spike scenario. It just crushes everything. And it has to be devalued. Not only does it need to be devalued, but the rest of the world begs the US to devalue. And the US wants to devalue too, because nothing works with the DXY at 160, right? And so there's another Plaza Accord type agreement or that's when the Great Reset comes in and they wipe out all the debt from the central banks, and then they come in with some kind of, multipolar currency basket. But I think that's what causes the Great Reset, is the dollar going much higher. And this is, could you bring the chart up one more time, please, if you don't mind?
Yeah.
Because I think this is important too for people to understand. And I know some people get this, but I know that some people don't. And so I've been repeating it quite a bit lately, but I think it's important to understand. The reason I've pounded the table on the US dollar going higher is not because I want everybody to rush out, sell everything they own, and put their whole life savings on the trade that the dollar goes higher. That's not the point of it. The point of it is that if I'm right, the dollar going above that major resistance line, I think there's a higher possibility of the dollar going above that major resistance line than most people appreciate and that is priced into the market. But if it does, if it goes above that major resistance line, it's not going to stop at 118 or 119. I think it's going to 130, 150, 160.
Well, technically,
And
there's not a lot of resistance technically above that.
Exactly. And that is a disaster for portfolios, a complete disaster. And so as someone who manages capital, not just for myself, but for other people, I have to be always on the lookout for what are the underappreciated risks out there. And if that DXY breaks above that thing and it goes from 115 to 130 or 140, that is going to be a portfolio killer, or it has the potential to be a portfolio killer. So I can't just ignore that possibility. So I am always on the lookout for that, and we have hedges in place that should that happen, it will help us protect against the rest of the portfolio. Now, we're not just sitting in cash, but the other thing is we're not just sitting in cash and dollars, because usually the central banks, the monetary authorities get things under control. They keep it within this band that the major support line and the major resistance, and it bounces back and forth. And over time, asset prices rise. So, I don't know how to time perfectly the end of a grand, global debt cycle. I just think that we've gotten to the point where global debts have gotten to a point where the likelihood of something bad happening as a result of all the debt is much higher than it has been previously. And so I'm always looking to protect against that.
Just to illustrate what you're saying earlier on about the price of gold, by the way, you can see how
that's perfect.
The orange line on here, by the way, is the gold price, and the price scale for that is on the left-hand side. The DXY is on the right-hand side. But you can see for many years now, the US dollar index has gone up, but the price of gold has shot up as well. So
exactly right.
If you're watching this, just forget those old wives' tales about the gold can't go up because DXY is going up. There's no. I mean, what would you?
Yeah.
I haven't really.
And the same thing, if you put a chart of the Dow or the chart of the Nasdaq up there, it would be rising as well. From 2008 till now, the Dow's tripled, right? And the dollar's gone up 30% since that time, or the DXY has gone up 30%. So again, in very short periods of times, typically a rapidly rising dollar in the short term is pretty negative for risk assets. But again, like you said, if you zoom out, it's not necessarily the case. You go back to 2008 till now, you've got the dollar up a lot, you've got the Dow up a lot, and you've got gold up a lot.
Yeah, the blue line on there is the Dow Jones.
Yeah.
Yeah.
So when it could happen, when the U.S. equities current rally pitters out, I don't know when, people wherever it halts this current SPX rally, that could mark the bottom for the US dollar. And as the US equities, if ever they plummet violently, then that's a scenario where it doesn't mean we have the milkshake, but you have a launch pad for a potential milkshake if things cascade.
I mean, it's really unlikely. It's really unlikely to see the Dow and the S&P crashing and the DXY falling dramatically, right? I mean, it's not impossible, but it's really unlikely.
Just another chart to illustrate, DXY, the relative strength of the US dollar, which is obviously what the DXY is. It's the relative strength of the US dollar versus principally the euro. So the relative strength of the dollar versus US inflation using PPI as a proxy for inflation. So clearly that chart just goes from bottom left to top right, but there are periods in time like the 1980s there, and also the period between around about 94 and 2001, and then more recently a long sideways period. So there are periods in time where the US dollar's strength can keep up with or outpace inflation, but as a whole, from the 1970s to now, over the last 50 years, the US dollar's strength versus inflation is struggling to make headway on those.
Right. I think that the important thing for me that I always try to get across to people is that those who believe that relative fiat currency levels do not matter, they absolutely do. And if you're lucky enough to live in a country whose currency has stayed strong versus the US dollar, then just count yourself lucky. Because there's many people out there who are not so lucky. And I can guarantee they will tell you that the relative strength of the dollar matters to their life.
Of course, yeah, absolutely. And of course, you can measure the US dollar index, but in gold as well. You don't have to measure the US dollar index in, versus another currency in particular. You can measure it versus gold, and the US dollar index versus gold keeps having these sort of surges to the downside here. So when measured in gold, we're also at a fairly sort of critical point here at the moment as well, because we're either about to break down. So DXY breaks down strongly versus gold, or it's going to bounce and move very strongly to the upside. So from a technical chart,
I totally agree. I think this is a very pivotal week for gold. I literally think we're right there right now. We're at the $2,000 level, which is kind of an emotional level. It's somewhat of a technical level, whether measured just in dollars or DXY. But I do kind of feel like we're at the point where something's going to make a big move one way or the other.
Jesus. But I'm super curious. So before you even came up with the milkshake, you did not even look at a chart, but you were aware of the DXY chart to some extent, right? That was in your back burner. You said, forget what happened in the past. I think what might happen in the future. So you didn't draw lines and say, for my milkshake to work out, this has to happen.
No, I kind of think it's an inevitability, because every time for the dollar to go down and stay down, you would have to see a change of behavior. But the problem is, every time the dollar goes down, rather than see a change of behavior, you see the world double down on what they've already done. They issue more dollar debt, they borrow more dollar debt, they continue trading in dollars. And so every time they take out more dollar debt, or they borrow more debt, or they issue bonds in dollars, that's creating demand for dollars. That's future demand for dollars.
What do you think? Sorry, go on. I just wanted to say, what do you think would be the impact of the introduction of a sort of competitive currency to the US dollar if the BRICS suddenly come up with an alternative? Is that?
Well, so the big problem there is that to date, all of those countries, well, the rest of the world, you could break it down country by country, but everybody knows the US owes 30 trillion in US dollars, but the euro dollar market, the dollar debt, the dollar credit that's been extended outside the United States by international entities that are not US entities is bigger than that. There's more dollar debt outside the United States than there is issued by those inside the United States. And so if we were to move to a currency, or if the rest of the world were to start to move to a currency other than the dollar, then that means that there are going to be less dollars circulating outside the United States, kind of by definition. But all that US dollar debt that they owe is still there. So they're already having trouble servicing and paying off all that dollar debt that they're having. What happens if they have now less dollars available to do it? I don't see how they pay off all that debt and service that debt with fewer dollars circulating. And this is the big problem with the system, is that it's a trap. And the more you try to escape it, the tighter the trap gets. So the more you try to get away from using the dollar, you borrow in other currencies or you use other currencies for trade, liquidity starts to dry up. And as liquidity starts to dry up, the trap increases in strength, or it tightens, right? It doesn't loosen. And so the rest of the world can't really get away from the dollar without going through immense pain, right? One way to get through to get out of a trap is you cut your leg off, right? Your leg is cut, your leg is caught in a trap. The only way to get away is you cut your leg off and you hop away. And so far, they haven't been willing to do that. And it makes sense. It's really, really hard, and it's really, really painful. And so if we get into this situation where all these headlines that have been said, we're going to start doing these trades in non-dollars, if that actually comes into being, I'm not saying it can't work, but it can't work without immense pain. And I just don't think we're anywhere near immense pain. And the pain, in my opinion, as they start to leave the dollar, it actually pushes the price of the DXY higher in the short term. Now, it can ultimately lead to the DXY crashing, but the transition period, I think, is very chaotic and very volatile. And in that chaos and in that volatility, I think the DXY index rises.
Wow, makes sense. But yeah, so the
We'll see.
DXY will so is this in line with the reserve currency change? This how does that happen? Like
Well,
the DXY
I mean,
before it did.
Again, I think the dollar is going to get so strong that either the US will devalue it or the world will get together in some kind of coordinated fashion and reset everything. But the system will not work with the DXY sitting at 200 or 180 or 170. I mean, it will just wreck everything. You will have a global depression in that scenario. And so I would expect in that kind of an event some kind of reaction from government, whether the US does it unilaterally or some kind of a bilateral global agreement. You know, I don't, it's pure speculation, but I just know the system can't function with the dollar that high.
It'll be fascinating to see how precious metals and cryptocurrencies react to all of this.
Yeah.
I know the younger crowd are very keen on cryptocurrencies, and that seems to be obviously a very big global trend at the moment.
Well, I think if we got into another, if your scenario where we go to that level B were to play out, I would expect crypto to do very well in that environment. Because I think for that to happen, you have to get into another liquidity event or a globally supplied liquidity event to push the dollar that low. And in that scenario, I would expect gold to do very well, and I would expect crypto to do very well.
Fascinating stuff, isn't it? Joining all the dots together, it's
it's quite a puzzle. It's quite. And here's the other thing: is like, you know, I've said several times that I think I'm right. I have conviction, but I don't have certainty. And even if I get it largely right, there's without question going to be big parts that I get wrong. There's no way I'm going to get it all right, and I know that. But my main focus is to protect against the unexpected. And I think breaking above that major resistance line is very unexpected by most people. And I don't want to be caught off guard by it because I think there's a higher probability of that happening than just about everybody else.
Well, yeah. Well, I think like the markets have broken down versus producer price index back in, I think, 2021, 2022. So a lot of people aren't zooming out. But we're back in the 2001-2 type scenario. We're back in the 1969-8 type of scenario, and we're back into a 1930 type of scenario. I don't think people appreciate that. I think right now everything, it's a bear market rally. If it does nominate a new high, it'll be marginal, and then it's a rug pull time. And that's what I think where we're at right now. And people, I don't know, people are still hopium. I don't know what they're doing, but it's hard to see this being a new bull era.
It's amazing. That's why I like this business. It's so crazy. It's maddening on one sense, but it's fascinating on the other. And I mean, I've been doing it for close to 25 years, and there's so much stuff I don't know, and you learn something new every day. And you know, I think if you can kind of keep an open mind, admit you might be wrong, and you know, you stand a little bit better chance than most. But nothing's for sure.
I think that commands a lot of respect, actually, because a lot of analysts that we talk to and a lot of people that we that we interview almost seem to have a complete blank when it comes to acknowledging any other possible scenarios. You know, it's almost this very single-minded, one-track view that some people have, and they're just not willing to accept A, that they might be wrong, or B, that there might actually be more than one possible future outcome. And you know, from my point of view as a scientist, you know, I have to say that, you know, if you're not prepared to accept that the future exists of many possible different scenarios, and all we're trying to do is trying to identify the most likely one, if you can't do that, then you probably shouldn't be in the game of prediction, really, because you know, you're not being realistic if you can't do that. So hats off to you for, you know, being able to sort of say that and acknowledge that point.
Well, I appreciate. I've seen your charts over the years, and you always do great charts. You know, sometimes I agree with them, sometimes I don't, but I always appreciate the work you've put into them. And you know, I think it was 2 or 3 weeks ago when I saw you had done this on, you know, the dollar and the milkshake. I appreciated that you did it because, you know, it's helpful for me too. And so I have no problem with people disagreeing with me. Doesn't mean I'm going to change my mind, but you know, that's how we learn, and that's how we kind of, you know, get more information, is hearing stuff we maybe haven't heard yet.
Yeah, it absolutely is. And I think very often people get too aggressive when they come up against an opposing point of view, and that kind of aggression just really doesn't sit well with me, because I want to sit here and debate the points like we have done today, discuss them in a kind of adult, kind of grown-up way, without feeling that you have to throw the toys out the pram just because somebody doesn't agree with what you're saying.
Wow.
So that's a
it's funny. I have a friend who I probably met him 5-6 years ago. He's the best money manager I know. I mean, he's brilliant. And he worked for JP Morgan for a number of years. He ran his own fund for a number of years. He kind of managed his own money for the last 4 or 5 years. And then he just recently went back and started working for More Capital. But he and I talk every week. And what we've laughed about this several times is that he tends to be an optimist and thinks things are going to work out. And I tend to think things are not going to work out, and I'm a little bit more of a pessimist. And so we'll debate like what will happen or what won't happen. But when you actually look at our portfolios, they're not that much different. So we're actually positioned pretty closely as each other. And if I had to stop managing my portfolio and just let him do it, I would be fine with that. But so it's interesting. It's great to talk to somebody who doesn't see things exactly the way you do. It's really helpful, actually.
And it is. That's a very good point. That's why I enjoy working with Pat, because we don't always have the same points of view. And when you've got somebody else to bounce these ideas off, and you need to be challenged, as I said before, my background is in science. And if you can't challenge a theory, if you can't challenge a point of view, then there's a big problem there. It has to stand up to challenge. It has to stand up to being examined under the microscope, and you have to be open to that, because we're here to discover where there might be some flaws in the analysis. And that's how you improve it. You can't improve something if you don't know, if you don't examine it and look for the flaws.
Yeah, totally agree. And the last thing I'll say on that topic, in case there's any young people that are kind of either just getting started or learning in this business and they're listening to this, I know when you're young and you're trying to make an impression and you're trying to build your business or build your reputation, you want to be right? And you don't ever want to be wrong. And so, you're kind of, the habit is to be overconfident or to not accept that you could be wrong. But it's really the worst thing. I actually don't mind when I get things wrong, because I don't like it. I don't like being wrong, but I've learned to accept it, because we're basically in the business of predicting the future. And anybody who thinks that they're going to be able to predict the future with no mistakes is the most arrogant jackass in the world. Right? Of course you're going to make mistakes. Nobody's a wizard. Nobody's omniscient. So if you make a mistake, just admit it and move on. And and once you do that, it's so emotionally freeing to be able to do that. I wish I had learned that lesson years ago, because it would have helped a lot. So again, for anybody out there who's just kind of getting into this, it's great to have conviction. I like to say I have tremendous conviction, but I don't have certainty on anything. So just kind of keep that in mind.
Yeah, and a big part of that is that you learn a lot from your mistakes. You don't actually learn very much when you get things right, because you just move on and you assume that everything you've done was perfect. Well, you might have just been lucky. You actually learn from your mistakes a lot more, don't you?
The worst thing that can happen is like I have a friend who he shorted the very first short he ever did. He made a killing on it, and so he thought this is an easy game, right? And then ever since then, it's not quite as successful. So having really early success is kind of a blessing and a curse, because it can give you a false sense of ability.
Yeah, 100%.
Yes, 100% agree. Because I remembered. And imagine this might not happen to you. Let's say the DXY does shoot up, and years later, you're sitting on your chair, you're 80 years old, and you say, finally, it wasn't the milkshake why it went up.
Yeah, no, exactly. It could be something else. Yeah.
It could be something else. Traders, we're wrong more than we're right. A trader, if he has 50% hit rate, that's very, very good. It's all about risk, money management, risk to reward. That's all we do. And yes, sometimes you say, oh, gold's going to go to 5,000. But if you ask me the probabilities of that, well, right now, since we're far from that, they're much lower than when we'll be at 4,500, But people have all binary in their heads. It's like, if he says milkshake, it has to be tomorrow and it has to be 200. There's no in between,
Exactly.
Like the probabilities, they morph over time. When we get closer, it's a tough concept for newbies. And like you said, that somebody bought cryptos in the March of 2020 and it shot up.
Yeah.
And he thinks he's going to have a hard lesson coming up. Hopefully
Sure.
it doesn't hurt too much.
Yep.
Do we close it up here? I think we did very good.
I think that's a good spot to do it.
Yeah, Brent, I really appreciate this. I know that everybody listening and watching this, I hope we weren't sort of interrupting you too much. I know people often.
No, all good. Let's do it again in a few. We do it again in a few months and see where things are at.
I hope we gave you a full chance to say everything you wanted to say. But yeah, it'd be nice to revisit this once we've got to either the sort of breakout point or that 95 level, and we can chat about this again. Okay, great. Thanks again for having me. I appreciate it. All right. Do you want to remind our viewers there where they could find all your stuff, Brent? Sure. Yeah. So my contact, I have a website, santiagocapital.com. It's really just contact information and a couple of legal documents that I'm required to have. But if anybody wants to get in touch, can do it that way. My business is I manage customized personal portfolios for very high net worth families and individuals. I'm very active on Twitter. Santiago AU Fund is the handle, but if you just search Santiago Capital, you'll find me there. And then I have a show that I do with a friend of mine called the Milkshakes Pod, Milkshakes Markets and Madness, and it's on YouTube and all the popular, podcast platforms. And we do it once or twice a week. It's typically a 20-minute conversation. We talk about the markets. We talk about things that are crazy in the world, and it's kind of a lighthearted take on what's going on in the world and the markets, and we have a lot of fun with it. So if you want to check out that, we'd love to have you. Good stuff. Yeah, I'm gonna subscribe right now to that. Okay, great. Me too. I'll be watching that this evening. Great. Thanks, guys. Thanks a lot. All right. Cheers, bye, Brent. Take care, man. Appreciate it. Bye-bye.